the last chapter, we saw that the producers make their decisions based on profit, which expresses their CBA. That is, the difference between the revenues the firm takes in and the cost it expends in obtaining those revenues. To understand how a firm makes such decisions, as well as how economists look at them, we had listed 4 areas that we need to understand in detail. Of these, we studied the firm's production function in the last chapter and understood the various concepts such as TP, AP, MP and the relations between them. But production is not the whole picture, right? Look at the diagram we had examined to see an economist's picture of how a firm operates. This part is clear to us now. Now these areas have to be explored in detail as well. First, we will look at the cost side, the second component of the seller's problem. What the firm must pay for its inputs or the cost of doing business. In order to produce output, the firm needs to employ inputs. All firms, from Chandra's farm to the big car factories of a tycoon to your local bakery shop, incur costs while making the goods and services that they sell. A firm's costs are a key determinant of its production and pricing decisions. So we will study the cost side in detail in this chapter. We will also examine more closely the relationship between the different types of costs a firm faces, what economists call its cost structure. Overall, in this chapter, we examine producer behavior or firm behavior. First, through its cost curves, which provide a relationship between a given cost of production and how much a firm will produce for that cost, and then by examining how exactly profit maximizing happens. In many ways, this chapter is similar to the last one. So just like we studied TP, AP and MP there, now we will define and investigate total, marginal and average costs. See how they interact within a firm and discuss their importance in firms surviving and continuing to do business or going under. Remember Rohit and his pizza business? He has been doing pretty well. In fact, Rohit has decided to move to the USA and set up a pizza shop there. Clearly, he is counting on the immense pizza demand from Crusoe to make a profit there. We are going to stick mainly with Rohit's pizza shop in this chapter, though occasionally we will see how some aspects would apply to some of our other producer heroes as well. Okay? Let's start. We begin our discussion of costs at Rohit's pizza shop. We will now go into Rohit's operations in more detail so as to uncover and understand these aspects. Rohit, the owner of the firm, has to buy flour, salt, vegetables, cheese, chicken and meat and other pizza ingredients. He also buys the mixers, the ovens, etc. and hires workers to run all this equipment. He then sells the pizzas to consumers to earn a profit. Simple enough? Well, no. Rohit still needs economic detectives like us to help him figure out how to reduce costs and optimize for maximum profits. By examining some of the issues and principles that Rohit faces in his business, we can also learn some lessons about costs that apply to all firms in an economy. Let us begin with the firm's objective. To understand the decisions a firm makes, we must understand what it is trying to do. As we know, in economics, we normally assume that the goal of a firm is to maximize profit. So what is the firm's profit? The amount that the firm receives for the sale of its output, such as pizzas, is called total revenue, which is nothing but PR equals P into Q. The amount that the firm pays to buy inputs, such as flour, cheese, workers, ovens, etc., is called the total cost or TC. Together, this constitutes Rohit's CBA. Rohit gets to keep any revenue that is not needed to cover the costs. Profit is a firm's total revenue minus its total cost. So profit equals total revenue minus total cost, or TR minus TC, which is nothing but B minus C, right? Rohit's objective is to make his firm's profit as large as possible. You'll see in the business studies module the different ways in which the profit is then used. But for us, we are just going to stop at the objective of maximizing the profits and not worry about what will be done with it. To see how a firm goes about maximizing profit, we must consider fully how it measures its total revenue and its total cost. Total revenue is the easy part in this. It equals the quantity of output the firm produces multiplied by the price at which it sells its output. So TR equals P into Q. So let's say Rohit used to produce 1000 pizzas and sold them at 200 a pizza. Then his total revenue would be 200,000. Easy, right? Yes. But the measurement of the firm's total cost is more subtle and requires more detailed examination. So we will come back to the revenue part after we discuss the costs. A word of warning before we proceed, this topic is also a bit dry and technical like the last chapter, to be honest. But these chapters provide a crucial foundation for the more interesting chapters we will pick up after it. So we are going to study the costs. Now we know that costs exist because resources are scarce, which means from the producer's perspective that they have competing uses. To produce more of one good means foregoing the production of another good. Such as, if Rohit decides to produce say momos instead of pizzas, what does he forego? Pizzas, of course. Each of the raw materials and resources employed by Rohit could be used for making some other good if they were not employed in its pizza making, right? The cost of producing a good is measured by the worth of the most valuable alternative that was given up to obtain the resources, which is called the opportunity cost. A concept we have seen in detail with Crusoe, his coconuts and fishes in the desert island. Opportunity cost is a central part of economics. Our old economics professor in campus used to tell us it is the most fundamental principle since it comes straight from the principle of scarcity itself. He even named the cafe in campus after this principle. It's called Cafe Tanstafel or Cafe There Ain't No Such Thing as a Free Lunch. Opportunity cost basically means nothing in life is ever free, and our prof wanted to rub this in every day. Economists in general are fond of the saying that there is no such thing as a free lunch, which is a saying whose origin is unknown but was popularized by the science fiction writer Robert Heinlein in his 1966 book, The Moon is a Harsh Mistress. When measuring costs at Rohit's Pizza Shop or any other firm, it's important to keep the opportunity costs in mind. When economists speak of a firm's cost of production, they include all the opportunity costs of making its output of goods and services. While some of a firm's opportunity costs of production are obvious, others are less so. When Rohit pays $100 for flour for his pizza base, that $100 is an opportunity cost because Rohit can no longer use that $100 to buy anything else. Similarly, when Rohit hires workers to make the pizzas, the wages he pays are part of the firm's costs. Now, because these opportunity costs require the firm to pay out some money in hard cash, they are called explicit costs. By contrast, some of the firm's opportunity costs, called implicit costs, do not require a cash outlay like this. Imagine that Rohit is skilled with computers and could earn $30, which is around 2,000 rupees per hour, working as a programmer. For every hour that Rohit works at his pizza shop, he gives up this 2,000 rupees or $30 in income. And this foregone income is also part of his economic cost of doing the pizza business. Thus, the total economic cost of Rohit's business would be the sum of his explicit and implicit costs. Now, this distinction between explicit and implicit costs highlights an important difference between how economists and accountants analyze a business. Economists are interested in studying how firms make production and pricing decisions. Because these decisions are based on both explicit and implicit costs, economists include both when measuring a firm's costs. By contrast, accountants have the job of keeping track of the money that flows into and out of firms. As a result, they measure the explicit costs but usually ignore the implicit costs. The difference between the methods of economists and accountants is easy to see in the case of Rohit. When Rohit gives up the opportunity to earn money as a computer programmer, his accountant will not count this as a cost of his pizza business, right? Because no money flows out to the business to pay for this cost. It never shows up on the accountant's financial statements. An economist, however, will count the foregone income as a cost because it will affect the decisions that Rohit makes in his pizza business. For example, if Rohit's wage as a computer programmer rises from $30 to $300 per hour, he might decide that running his pizza business is too costly in terms of the opportunity cost. He might choose to shut down the shop so that he can take a job as a high-paid programmer. Same thing can happen if the profits of running the pizza shop goes below what he could have earned in his other job. Eventually, he may stop his business and go back to being a programmer again. Cost of capital is another important area where opportunity cost concept is important. An important implicit cost of almost every business is the opportunity cost of the financial capital that has been invested in the business. Suppose, for instance, that Rohit used 10 lakh of his savings to set up the pizza shop initially. If Rohit had instead left this money in a savings account that pays an interest rate of around 5%, he would have earned 50,000 per year. To own his pizza shop, therefore, Rohit has given up 50,000 a year in interest income. This foregone 50,000 is one of the implicit opportunity costs of Rohit's pizza business. As we've already noted, economists and accountants treat costs differently, and this is especially true in their treatment of the cost of capital. An economist views the 50,000 in interest income that Rohit gives up every year as an implicit cost of his business. Rohit's accountant, however, will not show this 50,000 as a cost in the balance sheet, etc., because no actual money flows out to the business to pay for it. To further explore the difference between the methods of economists and accountants, let's change the example slightly. Suppose now that Rohit did not have the entire 10 lakh required to set up his shop, but instead used 8 lakh of his own savings and borrowed 2 lakh from a bank at an interest rate of 5%. Rohit's accountant, who only measures explicit costs, will now count the 10,000 interest paid on the bank loan every year as a cost because this amount of money now actually flows out to the firm. By contrast, according to an economist, the opportunity cost of owning the business is still 50,000. Why? Because the opportunity cost equals the interest on the bank loan, which is an explicit cost of 10,000, plus the foregone interest on savings, an implicit cost of 40,000. Now, let's return to the firm's objective: profits. Because economists and accountants measure costs differently, they also measure profit differently. An economist measures a firm's economic profit as the firm's total revenue minus all the costs, explicit and implicit, of producing the goods and services sold. An accountant measures the firm's accounting profit as the firm's total revenue minus only the firm's explicit costs. This figure here summarizes this difference. Notice that because the accountant ignores the implicit costs, accounting profit is usually larger than economic profit. For a business to be profitable from an economist standpoint, total revenue must exceed all costs, both explicit and implicit. Economic profit is an important concept because that is what motivates the firms that supply goods and services. To understand business decisions, we need to keep an eye on economic profit.